Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our monthly market update for October. Before I begin, we want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So before we begin, we want to thank a team member, Nolan Nair, for 12 years of service to our amazing clients. So congratulations, Nola. We also want to tell you that we look forward to seeing many of you, over 100 we're expecting next week at our October quarterly investment forum at Perry's. We still have a few spots available. If you haven't RSVP'd already, let our office know and we'll see what we have available. We also have an upcoming webinar on charitable planning. So if you haven't registered for that or need help with that, please let us know. I want to start with jobs. The most recent jobs report added 254,000 in September for for the month of September. 12-month unemployment sits at 4.1, an average hourly pay over the last 12 months up 4. So overall, a good jobs report. And with this month, we had a kind of a rare in recent months revisions to the upside on the prior 2 months. So overall, the September jobs report, especially coming off of a weak July and August, was good. You may remember we shared this slide with you before. The reasons the revisions to the upside were significant is that there were 800,000, over 800,000 revisions to the downside for the 12 months ending March of 2024. So again, a revision to the upside, given this backdrop, is worth paying attention to. Inflation has continued to come down from a high point of 9%. The most recent reading on headline inflation at 2.4 annualized and at core 3.3. So that was slightly lower than expected, the 2.4. The Fed did cut rates for the first time in 4 years last month in September of 2024. And we're anticipating more cuts both the rest of this year and into next. So the 50 basis points was a rather aggressive cut. So why did the Fed cut? Well, it could be that they saw soft jobs numbers in July and August, or it could mean that they feel like they've made sufficient progress on inflation. Either of these two are possible, and it is perhaps both. So as it looks to, again, a change from the Fed being raising, pausing, and now cutting, what does that mean as it relates to stocks and bonds? Well, if we don't go through a recession, which again is still an open question, if you look at after the Fed cut for the first time, it was very good in a no recession environment for stocks and bonds. Now, if we look to a scenario where we do get a recession, you'll see that's still good for bonds, but not good for stocks. So much of how equities and bonds have done historically after the Fed starts cutting rates has to do with, again, whether we do go through a recession or not. And this is just broadly looking at whether a recession or not, how stocks, bonds, and other asset classes have done after the Fed starts cutting rates. So you'll see generally supportive of long-term treasuries, growth stocks, core bonds, large cap, et cetera. You also tend to see a favorable return after money market assets peak. So 6.2 trillion is where money market assets are today. If the Fed continues to lower rates, the return or yield that you're getting on money markets will go down. And again, this being in a peak scenario is typically good for stocks over a 3-year period of time. So you see 3 other periods of time where money market assets have peaked. Those have been very good periods of time for stocks. So as we look at growth came in most recent quarter at about 3% and is projected to slow, but still be in a growth scenario. So again, a lot of the forecasting still deals with this. Do we get this soft landing, no recession environment, or do we get a recession? Again, as it relates to the the most recent estimates, we do see a slowing economy, but one that's still expanding. There are some trouble signs as it relates to the consumer that are worth paying attention to. Number one is debt service ratio. As interest rates have gone up, credit card balances have gone up, and so therefore the amount of percentage of income required to just service debt is now 10%. And you see delinquency specifically in auto and credit card have gone up. So the consumer, which drives 70% of the US economy, is showing some signs of weakening, and we're paying attention to that. On the earnings front, you've heard us talk a lot about mega cap tech. The S&P 500 X Tech reported the first positive quarterly earnings growth for the first time since 2022. So the market is showing some signs of widening out beyond mega cap tech. And this is kind of an example of that. During Q1, if we look at earnings growth, basically all of the earnings growth was in the Mag 7, mega cap US tech stocks. By the time you go out to Q2, it's starting to widen out a bit, and you see projected going into 2025, the delta between earnings growth on Mag 7 versus not is expected to narrow. So this would indicate a broadening out of market performance beyond the Mag 7 to the larger market. We did see a pretty significant pickup in volatility this summer. If we look at July 16 to 8/5, for example, in tech stocks, they were down almost 15%. But if you got out of the market here, you missed the fact that they were up 12% from early to late August. So if you took a 6-week nap here from mid-July on to late August, you may have missed all of this, but it was a wild ride over this kind of late July and into the third week of August timeframe. In fact, we saw the VIX decline, the largest in history over 7 trading days in August, going down 58% as the markets kind of unwound a lot of their volatility to the downside in late July and early August. We also had another event, which is from in August of 2024, the yield curve uninverted. So it had gone almost 800 days of being inverted, which means the short-term interest rates were paying higher than long-term. So that's another thing to watch. Another thing to watch is the U.S. debt, which shows no signs of improving. In fact, just visually, if this one square is $1 billion, what's below is $1 trillion. And the U.S. debt as of September of 2024 was 35.3 trillion. Which also means that the debt service is now over $1 trillion just to service the debt. So that's not paying $1 of the debt off. That's simply servicing that amount of debt. So some reasons for pessimism and optimism. Pessimism is we do get a recession. Again, there's no signs of that yet. But with a softening economy and a weakening consumer, that's something to pay attention to. The Fed cuts interest rates less than expected. Again, we had a news that was opposite of that in September, which is the Fed raised rates, if anything, more than was being expected. Geopolitical is a risk that kind of remains with us with 2 wars, one in Europe and one in the Middle East. Debt levels we talked about are a reason for concern. Earnings disappoint in an election year that's contested or challenged or something that we're not expecting. So all of these are reasons for pessimism. On the optimistic side, we do get the delayed recession along with rate cuts or tend to support financial assets. Inflation continues to moderate. The Fed continues to cut rates. The market performance widens. Earnings are good. An election year, regardless of the outcome, is something that's behind us. And we can focus more on what 2025 and beyond look like. We did recently rebalance just a few themes that we kind of talked about there as returning equities to a target weight, deployed some cash, a little bit less US dollar exposure. We retained but reduced our overweight in these areas, US growth and large cap, reduced energy exposure in an environment that has lower inflation. And we reduced small caps based on kind of where we are in the stage of the economic cycle. So we sent out trade notes in advance of that, but those are some of the themes that you saw in a recent rebalance. So none of this replaces contacting us about how all of these things apply to you specifically. So please reach out if you have any questions. Again, we hope to see many of you next week at Perry's, where we'll be talking about all of these items in more detail. And we hope that you'll join us the week after that for a webinar on charitable giving hosted by Fidelity. So with that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us, tell you what an honor it is to serve you, and please contact us if we can help in any way. Until we see you again, hopefully many of you next week, be well and take care.